Hello and welcome to Coffee with Switzer. I'm doing my quarterly catch-up with Michael Knox, the Chief Economist at Morgan's. And the reason why it's quarterly because he comes to Sydney quarterly to present his views on where the economy's going, what the stock market's going to do. Michael, thanks for joining us.
Thank you, Peter.
Okay, so let's just start with the big news story of the trade war truce. What do you think that's going to mean for all your predictions in this little quarterly presentation?
I think the trade war truce is real. I think both sides, as someone said, that if you're making a bargain, the guy who's the biggest buyer is the person who eventually decides the deal, and the US is the biggest buyer. Is the biggest buyer. So eventually, the Chinese had to come to an accommodation with their largest single market. Not for they don't sell steel there, but a whole lot of manufactured products go there, and so there has been a large number of issues identified. The most easily approachable is manufacturing tariffs. That if a car is made in China and exported to the US, it pays a tariff of 2.5%. But if a car is made in the United States and exported to China, it pays a tariff of 26%. Yeah. Now, that might have been fair when China was a small developing economy, but it's not fair now. So I think those are the first kind of things that will be talked about next year. But we note that this actually follows the situation where the US is also about to reach an agreement on the same sort of things with Europe. So I think China didn't want to be left behind. Okay.
And it's probable that inside that car that they've sold to America, there's some stolen IP they've never ever paid for as well. And that's an issue as well for Donald Trump, the IP theft. Peter
Navarro gave a speech to who's the
trade negotiator.
Yeah, head trade policy guy. He gave a speech at the Huntston Institute in the middle of the year, in which he went through the various issues associated with intellectual property, and he said you could negotiate 25 of these issues with the Chinese and there would still be 25 left. Mm-hmm. So I think the intellectual property issues are going to take years to work out, but I think they can do the car deal relatively early, and that's the one that's initially the most important for the Trump base.
Okay, all right, so one of the things I like talking to you is that around this time of the year I'd like to get your take on the economic outlook for 2019 and what should happen to stocks. So why don't we start off with what you think is going to happen to the stocks, and then we'll try and relate it to your economic view, if you think it's relevant.
Well, what's happened is after-tax earnings per share have slowed dramatically, were higher than anticipated in the third quarter. This is in the US. Yeah. Okay? And they grew at a rate of over 30% year on year to the Q3 this year. Okay? Now from that, you've got and why was that happening? Well, the economy was in great shape. There's fiscal stimulus, there's tax cuts to individuals, so they're spending more. But there's also corporate tax cuts which have increased. The corporate tax cuts increased after-tax earnings by about 12% in terms of the growth rate. Right. Now we're rolling off that, and the problem is you now have 3 quarters of flat earnings in the US. So that means the growth rate drops from about 30% to about 10%. So what you've got going forward is you've come off this exceptionally high growth rate of US year-on-year earnings per share, operating earnings per share, and you're going to back to a more normal level of growth of around about 8 to 10%.
Not bad.
As you go, not bad, but not spectacular. So if we look at it in terms of 12-month rolling operating earnings per share, which is what we actually use in our model of the US stock market, yeah, that's gone up 52% in the 9 quarters to the third quarter of this year. Staggering. Yeah. Absolutely staggering. Yeah. And that's why the US stock market has been so strong, and it's been rising at a level, it's gone to a level higher than fair value, particularly in the beginning of the year and up until recently, because it's rationally anticipating that high growth in earnings. Now that the respective earnings have dropped down to around about the long-term average, the market has dropped down to fair value in terms of our model.
And so the recent sell-off has basically reflected that?
Yes.
Yeah, okay. Right.
But now what that tells you is that the recovery in stocks through the year ahead will be much more modest than we've been used to for the previous 9 quarters.
But you still expect a recovery, but not a sensational one.
Well, yes, a more normal recovery, you know, which we've forgotten what it is because the stock market's US stock market's been so strong.
Okay. Do you place any track on the idea that historically the third year of presidency is good for the stock market?
Well, these things are wonderfully predictive until they're not. Also, there is the data which says after the midterm elections, well, it's similar. You have 9 good quarters, which is the quarter including the midterm election, and then the following 2 quarters, and 87% of those have been positive in the data since 1950. Yeah, all of those things are true, but I kind of like to look at fundamentals, you know. It's just that folks the old guy in me, you know.
Yeah, but also Donald Trump has done something unusual by giving all the good stuff early in his presidency. A lot of presidents hang on to after the midterms and start throwing at the economy in the 3rd and the 4th year to try and get re-elected.
Well, he was in the unusual circumstance of having a unified government, which is incredibly unusual in the US. A Republican House of Representatives, a Republican Senate, and the White House. So we could get the legislation through in those 2 years, whereas now we've got a Democratic House of Representatives, but we've got an increased majority for the Republicans in the Senate. So we can get any judge through that he wants to the Supreme Court or any other place, but he can't get money bills through as easily as he could before. Okay,
so let's go to the economic outlook. And I want to finish up, when you give me all that, what do you think happens in Australia? That'll be the last thing we'll do. So just give us the global outlook. Because a lot of people are worried about interest rates possibly rising too quickly, the trade war, commodity prices, and all those sorts of things. And Australia doesn't need commodity prices to fall, particularly with a house price problem. It'd be nice if commodities stay up as house prices come off the boil. I figure that's a fair call. So what's your outlook for commodities and the global economy?
Well, we'll start with the US economy, of course. You've got to believe that the Fed is going to deliver what it says. Now, this year we've got 2.9% growth for the US economy. Next year we've got 2.7%. But then in following years it falls down to 2 or below 2. What the Fed is trying to do is deliver what some economists call a soft landing or a growth recession. And that's where growth falls to a below trend growth rate, but not into negative territory, no recession, they avoid recession. But the growth falls so low that unemployment starts to go up and goes up again. And that's usually a pretty tough environment for equities. So out there, because earnings slow down, or there aren't any earnings, and so you will eventually get to a point. You might have you'll have a reasonable year in the year ahead, but after that, slowing growth and slowing earnings will really knock the stock market around.
So 2019, okay. 2020, get ready for some challenges.
Yeah, absolutely.
That's the US. Right.
Yeah. In Australia, we're really entirely dependent on the terms of trade in Australia. The reason we had better earnings last year is because we had a kick in commodity prices and improvement of the terms of trade. That generates more money in the economy, and that's why the economy feels a bit better, and unemployment is falling now to what the Americans call the natural rate, what the RBA calls the NAIRU. Below that level of 5%, you start to get increases in real wages and a bit of inflation. So we're moving to a part in Australia where domestically we go to an improvement in real wages, finally, next year and the year after, and a bit of inflation next year and the year after. That's so slow that we don't have to have any rate hikes before probably the end of 19 or 2020 or something like that. Yeah. But the problem for corporations in Australia is we need another kick in that terms of trade. We need another kick in commodity prices. And this year, that's been the better increases in volume of exports has been masked by flat prices and recently a collapse in in energy prices, which everybody's noticed. I think that's fundamentally because the US has had a significant, what we would call a counter-trend rally during the year. The US dollar index, which fell last year, has risen about 62% of decline last year. Now, next year, we think the US, there's a whole bunch of reasons for that, including US corporations bringing capital home to the US to get the lower tax rate.
Right.
Okay?
Yes.
But that bringing that money home from overseas, that this can only last for a year. Going into next year, you've got the problem of the expanded US budget deficit. There's a whole lot of bonds to sell, for the US has to sell. The Fed isn't buying anymore. They have to be sold to foreigners. The only way you can clear a market of that size is for the US dollar to go down. So we think the US dollar will go down next year, and that will generate a better kick in commodity prices. And so we'll have a better resources year next year and an improvement in the terms of trade.
The Aussie dollar goes up as well.
Yeah, and we think the Aussie dollar will go to about 77, 78 cents next year. Absolutely we do. But hey, that's not such a bad thing. You know, you can go to France more often.
That's right. But our stock market does benefit when the Australian dollar falls. So it sort of swings and roundabouts. Let's go to your call for the Australian stock market now, next year.
Our fair value at the moment is 59.20. 59.20.
Right.
So we see it improving next year to back over 6,000, but we need to have this recovery in commodity prices. If we have a big recovery in commodity prices, we can allow the stock market to go higher, but let's have that improvement in commodity prices first.
Okay. So I guess it's a fairly cautiously optimistic scenario, and it rests on commodity prices.
Yes,
okay.
For Australia.
Yeah, for Australia. If after 3 months of wide-ranging negotiations, Donald Trump pulls back on a lot of the tariffs, do you think that would be a big kicker to stock markets right around the world?
Well, he increased tariffs to 10%, and then the threat was that it was no movement from China. He'd increased tariffs further to 25%.
On $500 billion worth.
Yeah, well, there's the second one was the club behind the back, and that'll put a lot of pressure under China. I think that from now on, I think the advantage has moved to the Americans. The Chinese realise that the Americans are their biggest market, and they have to compensate the Americans for that. So at least we'll get a deal next year on car tariffs, and that'll stabilise the movement in relative tariffs relative to each other. Yeah. So there won't be any more increase in tariffs, but like I say, there's 50 different issues that Peter Navarro says have to be dealt with the Chinese in terms of intellectual property. Yeah. That's going to go on for years.
One last tricky question. If you were an investing man, and you are an investing man, would you be interested in buying an exchange-traded fund for the Chinese stock market?
Well, I think the Chinese economy has done badly, the Chinese stock market has done badly in spite of the fact that the Chinese economy has been doing okay. Okay, so I think that there's room for a recovery both in the RMB. I think there's a recovery in the Chinese currency because I think the US dollar is going to fall, and I think that keeps more money in China in the Chinese stock market and allows it to kick. But it's not something I model. So I only invest in things that I model myself.
It's not advice, it's just brilliant financial education. Michael Knox, thanks for joining us.
Thank you very much, Peter Switzer.
And it's nice to have you having coffee with Switzer.